Hello everyone and welcome back to another financial planning video. My name is Erin Varghese and I am a financial planner here at Pure Portfolios. It is a gloomy day here in Portland, Oregon, but nonetheless, we are going to be covering a topic that has been popping up in conversations this year with our clients. So we wanted to address it in case this is something that you are experiencing or need to hear. So one of the conversations that we have been having with our clients this year during a difficult market year is surrounding the topic of budgeting, and that is budgeting around markets only going up, or rather inflating your budget during a bull market. So we will get into some specific examples, but the overarching theme of this video comes from a quote from the well-known Psychology of Money book by Morgan Housel, and he says that the most important part of your plan is planning on your plan not going according to plan. Now, through 2020 and 2021 and 2022, there has not been a lot that has really made sense about the markets. And so this is a principle that we have instilled in many of our clients, is to plan on your plan, not going according to plan. So what does that really mean? It's that things are unexpected, life is unplanned. There's only one thing that is certain, is that it's not going to go according to plan, and that's okay. But why is this a problem? Well, we know that this decade has been a breeze by most investors' standards, and despite a few negative years, it's been pretty positive overall. We saw healthy returns, low volatility, and interest rates were close to zero. Along with positive market returns, increasing home prices had investors feeling like they just couldn't miss. You could throw spaghetti to the wall, and it would stick just about every time. And during the last decade, retiring was relatively easy. You could live off of your investment portfolio, take a draw, and in many cases still see your balances grow. Now, cut to 2020, this is the year that we have dubbed as the 180. We've seen increased volatility, rising interest rates, and home prices are starting to fall. Now, what we have noticed is despite the difficult market environment in 2022, we've seen retirees continuing to spend as though it's 2021. Now, is this inherently bad? No, not for everyone. But for those who have begun to spend in the last decade or so outside of what they have originally planned on in retirement, could prove to be detrimental to their financial plan. So it's a lot of information, but what does this actually look like in a real financial plan? How do these spending habits really play out in real life? So we release a blog every single week on Thursday mornings at pureportfolios.com, and that is a great place to find resources on current market events, how we're feeling about the markets, and different topics surrounding the psychology of money for investors. So we recently published a blog titled The Biggest Risk to Retirees Revisited. Published one a couple of years back talking about sequence of return risk, so if you're interested in that, check it out. But this more recent one touches on the spending habits of retirees, particularly during difficult market environments, and how it can really erode a retiree's wealth. So we're going to look at the same example that we did in that blog post. If you like the written word, go ahead and check out that blog post, but we are going to talk through it in this video. So here we go. So we've got our clients, Rupert and Agnes. They retired in 2010 with $1 million portfolio. In their original plan in 2010, they sat down with their financial planner and they said, we are going to take a 10% distribution every single year, about $100,000 from the portfolio. So how does this play out? Well, in year one, their starting portfolio balance is $1 million, right? They just retired. They have their full retirement savings left. Rupert and Agnes, in their portfolio, it achieves a 7% return, or over the course of that year, about $70,000. So at the end of year one, their portfolio balance is now $970,000. We're going to talk through the math here. They started with $1 million. Their investments returned $70,000, so now they have $1,070,000, and they took out $100,000 in distributions over the year, leaving them with now $970,000, or a net $30,000 down. Let's move on to year two. So in their second year of retirement, their starting portfolio balance is now $970,000. We'll move through this a little quicker now. Their portfolio achieved now more, a 10% return of $97,000. And despite taking out that $100,000, their year-end portfolio balance is relatively unchanged. They have $967,000 left. Through dividends and interest and the appreciation of their assets, we added another $97,000. Throughout the year, again, we took $100,000 as according to their plan. And as we already said, they ended with $967,000. So let's move on to year 3. This is where it starts to get a little hairy. This is where it does not feel good for a new retiree. Remember, they're just starting their 3rd year of retirement. Started with $1 million. In year 3, they are starting with 967, but they saw an 18% decline in their portfolio value. So that 18% was about 174,000. That's a pretty deep bath to take. Couple that with their $100,000 distribution, they're now left with 692,000, just shy of 693,000 left. It's a tough place to start for year 4 of their retirement, but they're going to continue taking their 100,000 out, and we will move on to year 4. So their starting portfolio balance again was 693,000, let's call it. There's another modest decline this year, another 5%. So including their distribution, they are ending their 4th year of retirement with $558,293. So remember, we started retirement with $1 million, and just 4 years later, we now have about 550,000 left. Now, Rupert and Agnes have cut their investable assets almost in half in just 4 years, and unfortunately for them, this is something that they likely will not recover to their original balances from during their lifetime. Their depleted portfolio value is pretty unlikely to support their high level of spending, so this means that they are at risk of running out of money. We'll go over quickly how did this happen and then get into some of the solutions. So, how did this happen so you can avoid it? First is lifestyle creep. So this happens when increased income, or let's say increased portfolio values, leads to increased discretionary spending. So you see a little bit more in the bank, it kind of emboldens you to take more out. You can also think back to potentially your younger years. What used to be a luxury eventually becomes a necessity as you start to make more money. Once you really get used to that higher cost lifestyle, it can be really difficult to downshift. And so oftentimes investors and just people in general get used to spending more. Now, this happens to a lot of people, so if this is you are certainly not alone. It's something to be aware of if this isn't a situation that you are in quite yet, but it's something definitely to keep in mind. The second reason that you can run into this is forgetting your long-term plan. Now, way back when Rupert and Agnes retired, that 10% withdrawal rate might have been a little bit aggressive, especially on a $1 million portfolio. But at any rate, no matter what your plan is in the beginning of retirement, if you've mapped out that you can take 5 or 10% out of your portfolio to help supplement your lifestyle and your projections work out and everything looks good, if you forget what that plan is and you kind of go off track, you start doing something else, you abandon your long-term investment and financial plan, that's really what leads you to risk of ruin. Forgetting what your long-term plan is can be detrimental. Now, of course, your financial plan is going to change. Experts say that your financial life changes about every 6 months, so there will be tweaks. But you should really use your financial plan as a guide, a way to make financial decisions within the context of your financial plan. Because when financial situations arise and you start making decisions outside of the scope of your financial plan, that's when you can get into a situation like Rupert and Agnes and be at risk of running out of money. And that is one of the most important things that we are trying to avoid for our clients. So, all of that to be said, what can you do and how can you avoid this situation? Well, first, we want to make sure that you are right on track for retirement, whether you are coming into retirement in the next couple of years or you are already retired. We want to make sure that you are on track. So start with the cold, hard numbers. Make sure that your inputs are correct because bad info in gives you bad info out. So we want to make sure that what we are putting in is right. Next is to rerun your financial plan. This is where we start to stress test the plan. Where are the breaking points? One of the things that we do to stress test financial plans is running it with lower portfolio values. In 2022, portfolio values are lower, so make sure that you are rerunning your financial plan, making sure that your long-term projections still work even at these lower values. The next place to stress test is to continue out these lower returns that we are experiencing in 2022. If your financial plan hinges on a certain level of market returns, let's call it 5, 6, 7%, try running your plan with 3 or 4% to see how it works out. When do you start running out of money? Again, where are those breaking points? You can also try cranking up your expenses, say by 40 or 50%. What if your expenses need to or happen to be higher in the future? Does your financial plan still work? If your plan is still favorable despite higher expenses, lower market returns, loss of income or wages, if your plan still works through all of that and potentially other factors, then that means that you've built in a margin of safety into your plan. And remember, your plan isn't going to go according to plan. So these are the kinds of things that we plan for on the front end. The next thing that you can do is revisit your budget. Now, you probably did something similar maybe back when you were working. You start hearing whispers of layoffs, maybe revenue was down. Often families and individuals would cut back during those times. You probably didn't continue to spend freely if you were at risk of losing your job. Now, revisiting your budget doesn't mean that it has to be extremely restrictive, that you can't still uphold the level of lifestyle that you do now, but it's always good to revisit the numbers, see what you're spending on, and if there are areas that you could cut back on, to do so. And last but not least, we always talk about optimizing the things that are in your control. We often talk with clients and prospective clients alike who are worried about every ebb and flow of the market, or who's in the White House, what inflation's doing, what the feds are going to do next. And quite frankly, those things are all out of our control. Sure, they have an impact on the markets and the economy, but obsessing over those things aren't going to change the outcome of your financial plan. So it's time to look inward. What are the things that you can control? How much are you paying to your advisor? Do you have expensive mutual funds in the taxable account that are spinning off large capital gains at the end of the year? Maybe you're taking on too much risk in your portfolio for the level that is needed to have a successful financial plan. We call this cleaning up your financial household, just taking inventory on what you've got going on. And as always, if there's something that you can clean up, time to clean it up. So if you do these things like rerunning your financial plan, revisiting your budget, stress testing your plan, and taking the low-hanging fruit, optimizing the things that are in your control, you will feel a lot better about your financial situation. And if there is something that needs to be fixed, you will identify it and be able to fix it. So again, this is a conversation that we have had with a wide variety of clients this year. I hope that this was helpful and that you learned something. But if you've got more questions, you can always reach out to us at insight@pureportfolios.com. And we hope to see you in the next video. Bye.